Today we are going to talk about a beautiful book written by a guy called Carl Richards. Carl, a journalist, had a wonderful habit of sketching his ideas and thoughts. And at one point, he would go to a restaurant or a coffee shop, and if an idea came, he would sketch it on the paper napkins. Eventually, those sketches became so famous that Carl Richards today is known as the sketch guy. Being in the world of investing, some time back he came across a study by an agency called Dalbar, based out of the US. Dalbar conducts a particular study, and that study is published regularly. Even now it's available. What they do is they look at various investment avenues, the returns generated by those investments versus how much returns the investor actually got in hand. Now somebody may wonder, what is the difference between the two? Well, the difference was huge. According to that study, the investment generated something like 10% annualized returns. The investor took home roughly around 4% out of that. And this was very surprising for Carl. He read the report further and figured out. And that's where one of his most famous sketches showed this much was the investment return and this much was what the investor got. The gap between the two is what Carl called the behavior gap, which is also the title of this book. What are the factors leading to that behavior gap? Two obvious factors are the transaction costs. So whenever you are entering or exiting, there are transaction costs, and the taxes. Whenever there are profits, you pay taxes on that, and both bring down the investment returns. But the biggest contributor to this behavior gap happened to be the behavior of the investor. So it was not the investment, it was the investor. Let's elaborate on this. If an investment delivers 10% returns, what should an investor do to get that 10%? And that's very simple. You invest in the beginning and hold on till the end. The investment delivered 10%, the investor got 10%. But what happens is, and especially in stock markets, the investment delivers good returns, but those returns are not linear. They go up and down, and in that process, the investor towards the peak gets greedy and invests, and towards the bottom gets fearful and pulls the money out. And if we keep doing this again and again, we are turning that conventional wisdom upside down. Instead of buying low and selling high, we are buying high and selling low. And that pulls the investment returns down. Why does that happen? So he's got a beautiful sketch for that as well. He says towards the top, it's the greed that we buy, and towards the bottom, it's the fear that we sell. He extends that further through a beautiful Venn diagram. And that Venn diagram shows on one side investing by looking at past performance. Now towards the top of the market, the historical performance looks awesome. And towards the bottom of the market, it looks pathetic. And because of that, if we look at the past and invest on the up cycle, at the end of the up cycle, if I get and the down cycle starts, or at the end of the down cycle I exit and the up cycle starts, I miss out on the upside and I participate in the downside. In that Venn diagram that I just mentioned, he says one side it's the investment by looking at past performance. The other circle says driving on the road by looking into the rear view mirror. And both have one thing in common: you will meet with an accident. Driving on the road, the vehicle meets with an accident. Investments, the portfolio meets with an accident. He's got some amazing diagrams to illustrate certain very powerful points. One of my favorite diagrams is where he says one circle he depicts as things in your control, and the other circle says things that matter. And the common portion between the two, the overlap between the two circles, is the area where the investor should focus on. So first of all, things that matter. Now, whatever doesn't matter, you really don't need to do anything about it. But even out of what matters, if things are not in your control, you can't do much about it. Don't focus on that, because that focus on things that you can't control may lead to incorrect behavior or mistakes. But what we can control, if we focus on that, then we are likely to get larger share of the investment returns. I found this book to be very interesting. It does not tell you where to invest. It tells you why invest at all and how to invest. It's not about the outside world, it's about us. I very strongly recommend that every investor should read this book, Behavior Gap by Carl Richards.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.